Welcome back to the channel. As always, if you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a stock called TOST Incorporated, ticker TOST. And what they do, they are a cloud-based digital platform payment service for the restaurant industry in particular. Okay, so in terms of the company, if you look at the long-term chart, they had a pretty good start when they went public. This was the COVID boom, but as you can see, the stock fell by a lot and is now starting to recover. We are now, as you can see, in a bit of a long-term trend, which is going upwards. And I think this trend is going to continue. So let's start from the beginning in terms of what happened with the stock. As we mentioned, they fell a lot. And the reason why that happened back in 2019 to 2021 is because they were burning about $200 million annually by serving just under 50,000 restaurants. So in 2022, the stock crashed because they were losing money on every restaurant that they added. The customer acquisition for that was about $30,000, and that also assumed a payback period of more than 36 months. So, of course, the market realized that this was growth but no profitability. And especially at a time where the whole market was going down, that resulted in the stock getting obliterated. But as you can see, the company prodded along, and between 2023 and 2024, things started to change. Okay, what they did is management took over the business and restructured the operation. So they started by firing about 10% of the workforce. They raised payment processing fees from 0.45% to 0.56%, and they focus on profitable segments only. The result of that was that they went from a negative 20% EBITDA margin to a positive 30% in 18 months. So that's a pretty good turnaround. And now we are about to witness a series of catalysts which will serve as proof to solidify that growth strategy. So first of all, the company, as of Q2 this year, has completed just under 150,000 locations. That is about a 16% increase year on year, and each location adds about $6,000 to their top line when you combine SaaS and payments. They also expect to add about 21,000 net new locations, which supposes $126 million incremental revenue for them. So when we look at those numbers, you can see that at the moment, right, that is a significant chunk. It's not huge, but it is significant to keep driving the growth, at least for now. And at the same time, you can see how margins have progressively gotten better year after year. Okay. And at the same time, their cash and equivalents are up, their debt is down significantly, and the cash from operations again keeps growing year after year after being negative for a few years. So all that looks pretty good in my book. We also have another driver, which is the ARPU expansion. And in here, the company is projected to experience about a 30% growth. So first of all, for the SaaS segment, they expect to grow the ARPU, the average revenue per user, to about 5% annually. So that is a growth between, from $5,000, adding another 250 additional dollars per user. The take rate has expanded, and they have this a lending business called TOST Capital that adds 10 basis points to the take rate. So with that, the combined ARPU growth on those almost 140,000 locations is about $100 million. Again, that adds to the number that we have here. And then we have the driver number 3. So the gross payment volume per location is also expected to grow about 30%. So even with the same store sales down in their customer base about 1%, the total GPV grew about 23%. So that means that the GPV is going to grow from 160 billion to 197 for this year. So that is another incremental $207 million. So when you add all those things up, coming back to the numbers here, that represents about a $500 million in 2025. It is significant. But at the same time, those projections are quite realistic when you consider all those drivers and you consider all the things that they're doing to get to those numbers. So on the APS side, how does that translate? Because so far we've only spoken about top line. The gross margins are expected to grow from 50 to 70%, driven by payment optimization and pricing power. EBITDA margins are estimated to remain at 35%, and all that compounds to a growth in 5 cents on the EPS per $100 million revenue. But at the same time, there is more next steps that the company is taking. One thing that I believe is quite significant for them going forward is the fact that in the past, they failed to capture enterprise deals with larger customers, which are significantly more profitable than smaller enterprises. So that is something that they struggled with and had to scrap. But now they have achieved different partnerships with successful enterprise ventures that they're now testing. We will see the results for that in the coming months. And again, that solidifies that as a proof of concept for them to go to the market and pursue more relationships. So in terms of secured enterprise wins, they have secured 200 locations with Sweetgreen and 50 with Applebee's. And those were pilots, not commitments. But now Applebee's has committed 1,500 locations. Firehouse has committed 1,300 locations. And Potbelly and Perkins have committed 500 locations each. According to management commentary in the previous earnings call, their pipeline for locations and partnerships has never been stronger. So we take a step back and look at the numbers for this enterprise theme. Enterprise locations generate about $15,000 in annual revenue versus the small medium segment, which is $6,000. So those 4,000 enterprise locations alone that that I've just listed represent a 16 million incremental high margin revenue. Again, their margin is bigger, is higher compared to the SMB. So that is something that I think will be solidified as the months go on, and definitely will raise investor interest because it propels the narrative that the stock is growing, but it will continue to do so. So one of the reasons why that will be the case is because the platform network effects will be kicking in. So TOST Capital, like I mentioned before, can lend about $2 billion annually at 10% spreads. That adds another $200 million in revenue. They have a supplier network with more than 10,000 suppliers now integrated. saving restaurants about 10 hours per week. And they also have a lot of guest data. So that is about 100 million unique diners, enabling personalized marketing. So that also represents a 6% in check size increase. So over the next 3 months, perhaps a little bit longer, we should probably see the stock coming back to these levels here, just below 50 or perhaps even more. The things to be, the things to look for in that would be the Applebee's and Firehouse implementation validation, the earnings, which are coming at the moment, is not very clear what's been happening, but it's probably going to be happening around November. New enterprise wins and the take rate expansion. So TOST, as a summary, spent between 2019 and 2023 building enterprise capabilities while burning cash. Now they have the product, the proof points, and are landing, and they're generating $300 million in free cash flow. And these catalysts will become obvious as the months go by. Of course, we have seasonality, and the risks of the trade are that if the market reverses and the economy is subdued, maybe the customer will be a little bit soft in their spending. Perhaps outdoor dining will be a little bit subdued. And of course, the company might experience some snag with these partnerships, or perhaps may fail to secure additional partnerships that drive investor attention. But overall, the chart is telling us at the moment that we might be hitting a new low pretty soon. Continue to a reversal over here into this channel. Hope you enjoyed the video. See you soon.